This is the Cash Value Solutions Podcast, where your hosts, Jason Pohlmeyer and Kyle Manns, shed light on little-known money truths to help you take control of your financial future and become your own banker. Subscribe, rate, and review the show, and check us out at cashvaluesolutions.com.
Hey guys, welcome to the show this week. I'm Jason, and I'm here with my partner, Kyle. And what are we going to dive into this week?
Well, this week we're talking about banking basics.
Banking basics and how that relates to IBC, right?
Yep.
Okay, you guys have heard me say this over and over and over again, and you'll probably continue to hear me say it over and over and over again. But banking is simply the process of depositing, borrowing, repaying, and withdrawing money. Okay, so we know what banking is, the functions of it. What is money, Kyle?
Money is just a medium of exchange. Today's money is not backed by anything. And what I mean by that is it was like 1971. Before 1971, the dollar was backed by gold. So you could exchange your dollars for gold.
You could back in before FDR made it illegal, right?
That's true. That's also true, yes. It's in the 30s. But it was backed by gold up until 71, I believe. And now it's not backed by anything besides the fight and might of the U.S. government. So that is what we call a fiat currency.
Yeah, and it just so happens that fiat currency can be inflated very easily. And what happened in the 70s and 80s, right after the dollar was unlinked from gold?
We saw some inflation.
Yeah, it's stagflation. You guys can probably remember that from history class. So that's a little background of what money is. It's just the medium of exchange that we use to perform the banking function in our lives. So maybe we should tackle how banks actually make money. What do you think of that, Kyle?
Yeah, so banks make money by getting deposits into their bank, and then they lend out your money. They don't lend out their money. And also, when they're lending out your money, they practice what is called fractional reserve banking. So if you deposit $1,000, they can lend out $10,000.
Yeah, and actually, those restrictions have been lifted as of March 2020, and now banks don't even have reserve requirements.
Yeah, insane.
Let's go through a simple example without fractional reserve banking and show them just how profitable that the banking business is. Okay, we'll try to keep this really simple so you guys can follow along. Imagine you have $100 that you deposit in the bank, and they're paying you 1% on that $100 to keep it with them. Over 1 year, you'd get $1 back. Now imagine that I am going to the bank and I need to borrow $100. So the bank lends me your money, and I agree to pay them 5% interest on that $100. So the bank receives $5 for lending out your money, and it costs them $1 to use your money. Okay? $5 for me to use your $100 over the course of 1 year, and you received $1 that year for depositing the money with them. So what do you think the bank made in this scenario, Kyle?
Well, typical people just see it as the spread and would think, oh, they made 4% because 5% minus 1% is 4%. But that is not the case here. They actually made 400%.
Yeah. So think about what happens if you guys would double your money. What would happen? Instead of $1, you'd have $2. Okay. Now let's go back to our example. It cost the bank $1, the dollar they paid you to have your money on deposit, to make $5. So they turned $1 into $5. So a simple way to do this in the future for you guys is take the interest rate that they charged on the loan and subtract what they paid you for the deposit. 5 minus 1 is 4. And we're talking in percentage here, so move the decimal to the right 2 times, and you get 400%.
Mm-hmm.
Pretty crazy how profitable that is. But that's before we even talk about fractional reserve banking.
Yeah, so you can take that number times 10.
Yeah.
So we're talking 4,000.
4,000%. And we should say that banks currently aren't lending that heavily right now, but it is good to be aware that they do have the ability to do that legally. If you and I tried to do that, Kyle, what would happen?
It'd be jail time.
Yeah, jail time. It's unreal that they're granted this ability to do that. And it's just good for you guys to be aware that that's how the banking at your traditional bank is actually happening. And it's one of the main ways they make their income.
Yeah, yep.
So I think we should also just, tell people, okay, we're relating this to IBC and we want to keep this really basic because we understand this can be confusing to you guys. So we want you to see that this banking function has to be performed in your life.
Yeah, and you have to know what banking is to take over the banking function in your life.
Exactly. We want to keep, like Kyle said, you got to know what it is before you can take it over. That's the point of this podcast, so you can understand that. And once you understand what banking is, you realize, oh, hey, this has to be performed in my life because whether I'm buying bread or a vehicle or I'm buying a house, money has to change hands, okay? Remember, deposit, withdraw, borrow, repay money, okay? That's the banking function.
Yep.
And it's also important that you guys remember money has to reside somewhere, okay? Let's do a little exercise here. Kyle, what happens when you get a paycheck?
Well, typically, I would put it in the bank.
Okay. So you receive some money for your deposit, I assume. But who shares in the profits when you deposit your money at the traditional bank?
That would be the stockholders of the bank.
Okay. Would you like those to be shared with you?
Absolutely.
Absolutely. I like that answer. Okay. Next question. How do you currently finance your purchase of goods?
Well, the average American would go to the bank and take a loan out.
Okay. Or they could potentially pay cash even.
Cash, yes.
Right. So now all of a sudden, doing either of those functions, we have interest. We're either earning it on our deposit or we're paying it with a loan. And it's important to remember that you finance everything you buy. You either pay interest to someone else or you give up interest you could have earned. There are no exceptions to that rule, guys. You have to understand that as well for infinite banking to make sense.
Yes.
Last question I have for you, Kyle. Do you have liquid capital in a place where you're guaranteed to have more money than you put in?
Well, once again, speaking from the average American, most of our capital is tied up in vehicle loans, home loans, and then whatever else that we can manage to save is put in qualified plans. So, no.
All right. I think we covered this one time, but it won't hurt to bring it up again. It's also important that you guys remember, just because you put money in a qualified plan, that doesn't mean you're saving money. Okay, you saved money by not taking it all and putting it into the bank. But as soon as you put it into your qualified plan and it was exposed to the market, you invested it. Mm-hmm. And once you invested it, you have the possibility of losing some of that capital. Now, That can go the other way too. You can earn money, but it's just good to know the difference between saving and investing.
Yeah, and so when we get down to it, kind of like we've said before, the IBC is really just a system to accumulate capital and use it as a financing tool to recapture lost opportunity costs where we would have lost either paying cash by not gaining interest on the money that we had or by financing through somebody else and paying them interest.
That's the problem that we're solving with the infinite banking concept, right?
Yes.
So, I mean, that is as simple as it gets. We're not trying to make this complicated, but we understand that there are things that don't make sense when somebody researches this. But in the very basic, simplest sense, that's all that we're doing with the infinite banking concept.
Yeah, and like Jason said, I mean, this can be hard to understand. And over a podcast, maybe you can't wrap your mind around opportunity cost. And in the show notes, we will include a graph that we have that illustrates opportunity cost very well.
Yeah, I think that you guys could benefit from looking at that. And we aren't going to try to explain it over the podcast because that's very difficult for somebody to visualize. But I also want to just throw this point in there that once you become your own banker, once you perform the banking function in your life, you have to be responsible and treat your banking business just like the bank does down the street in town. You have to be willing to charge yourself interest or pay interest for the use of money. There is no business that would give you a free loan.
With great power comes great responsibility.
I think that's an excellent way to close out the podcast. What do you think, Kyle?
I agree.
Okay. Thanks for tuning in, guys. We'll talk to you next week.
This was the Cash Value Solutions Podcast. Remember to subscribe, rate, and review the show. Check us out at cashvaluesolutions.com. And don't forget to tune in next week.